Ladies and gentlemen, when you drive a car on the highway, for the most part, you can and should drive your car at a relatively high speed. But every once in a while, when you approach an obstacle, you must slow down so as to avoid an accident. Similarly, when it comes to your investment journey, you can and should adopt a rather aggressive posture in your investment portfolio for the most part. But at the same time, it's also imperative that you must slow down your investment journey as and when you come across air pockets and turbulence in equity markets. In this video, I'm going to discuss an eye-opening investment strategy that can potentially help you predict the onset of turbulence in equity markets such that you can avoid the turbulence and its adverse impact on your investment journey. What exactly is this strategy? Let's explore. Ladies and gentlemen, I have long believed and argued that if you're investing in equity markets, then your investment journey is likely to be very similar to driving a car on the highway. What do I mean by that? Let me explain. While driving a car on the highway, you can drive at a relatively high speed for the most part. But every once in a while, you're also going to come across obstacles. And it's but natural that you would slow down as you approach the obstacle, because if you do not do so, there's bound to be an accident. In the same vein, if you're investing in equity markets, you can in fact afford to adopt a rather aggressive posture with respect to your investments for the most part, because equity markets usually are in an uptrend 70 to 80% of the time. But just like driving a car on the highway, in your investment journey as well, you are going to come across obstacles and hiccups every once in a while. And when that happens, it's imperative that you slow down as you approach the obstacle, because otherwise there's bound to be an accident, just as is the case when you approach an obstacle while driving a car on the highway. But when it comes to equity investments, how can you possibly apply brakes and slow down your investment journey as you approach an obstacle? Well, when it comes to equity investing, there are only two ways to slow down your investment journey. First, you can outright abort your investment journey and get out of equity markets. Second, you can increase the share of debt funds or fixed income funds in your investment portfolio, and that will help slow down your investment journey. And I know what you must be thinking at this stage. You must be thinking that what I'm suggesting pretty much amounts to trying to time the market, something that investment experts and advisors unanimously advise retail investors not to indulge in. Instead of trying to engage in a debate with those who argue against the virtues of trying to time the market, what I'm going to do in this video is to present to you hard data on what kind of outcomes have historically been achieved by undertaking an investment journey without necessarily trying to time the markets, without necessarily trying to slow down your investments, even in the face of obvious obstacles and hiccups on the horizon. And then compare that with outcomes whereby the investment journey was deliberately slowed down whenever there was an obstacle or hiccup that was visible on the horizon. Let me start by explaining to you the outcomes and the kind of accidents that typically happen when you undertake your investment journey without trying to apply brakes, without trying to slow down, even in the face of obstacles and hiccups on the horizon. And in this context, I want to explain to you what's been the historical performance of a SIP-based investment in Indian equity markets. And the reason I'm trying to focus here on a SIP is because in a SIP-based investment approach, there is no asset allocation. At all times, your asset allocation is 100% equity. There is no debt in your investment portfolio which can potentially slow down your investments when there are obvious obstacles and hiccups on the horizon. So let's quickly review what's been the historical performance of such an investment approach. The chart that you see on your screen right now represents the historical performance of a 5-year SIP in the NIFTY. This is also called the rolling return of a 5-year SIP in the NIFTY. If that sounds like a lot of jargon, don't worry. I'm going to break it up for you in very, very simple language. Now, as you can see in this chart, we have had as many as 124 months that have already passed by since January 2010. And had you started a 5-year SIP in the NIFTY in any of these 124 months, then the return that you would have got at the end of each of these 5-year SIPs is what I have tried to depict in this chart. And if you're wondering what's the point of doing such a humongous exercise, then well, only if you do this exercise will you come to know what has historically been the best case, worst case, and median case outcome of a 5-year SIP in the NIFTY. So let's check that out. Historically, the best case outcome of a 5-year SIP in the NIFTY so far since January 2010 has been 20.35% per annum, and you would have got this return had you done a 5-year SIP in the Nifty between October 2019 and October 2024. The worst case return of a 5-year SIP in the Nifty since January 2010 has been negative 5.82% per annum, and you would have got this return had you done a 5-year SIP in the Nifty between April 2015 and April 2020. Ladies and gentlemen, what this chart is essentially telling us is that the outcome of your 5-year SIP in the Nifty almost entirely depends on market conditions during the course of your 5-year SIP. If market conditions are favorable, if markets are witness to very strong rallies during the course of your 5-year SIP, then you are very likely to end up with a spectacular return at the end of your 5-year SIP, as indeed was the case between October 2019 and October 2024. Because this was a 5-year period which came to an end around a time when the Nifty hit a new all-time high of 26,216 points. However, if you are unlucky and market conditions are not favorable during the course of your 5-year SIP, if the markets are witness to a very large market crash during the course of your 5-year SIP, especially if such a crash comes closer towards the end of your 5-year SIP, then you can also end up with negative returns. This is exactly what would have happened had you done a SIP in the Nifty between April 2015 and April 2020. Because this 5-year period came to an end in April 2020, which is exactly when we got the onset of the COVID pandemic, which in turn led to a brutal 38% crash in the Nifty. Ladies and gentlemen, there you have. When the going is good, when market conditions are favorable, you can end up with returns as spectacular as 20.35% per annum at the end of a 5-year SIP in the Nifty. But look at the worst case return of negative 5.82% per annum. This is what happens when you get air pockets in equity markets and you continue to drive through these air pockets without slowing down your investment journey. And well, if you ask investment experts about these sharp drawdowns in equity markets from time to time, well, the only answer that you're going to get is that such sharp drawdowns are inevitable and that there is no way to predict the onset of these kind of sharp drawdowns. And therefore, as part of being a disciplined investor, we must learn to accept these sharp drawdowns in equity markets every once in a while. Or at least that's what these investment experts would want us to believe. Ladies and gentlemen, I don't know about you, but if I were to be told that, that would sound to me almost akin to a car driver being told that he can follow all the traffic rules and yet he should learn to accept few near-fatal accidents every once in a while. Needless to say, that's not quite how road safety should be all about. Road safety is about slowing down in the face of obstacles in order to avoid accidents. Road safety cannot be about accepting few accidents every once in a while. Ladies and gentlemen, this brings us to the most important question, which is that, is there a scientific way to sense these obstacles, sense these air pockets, so that we can slow down our investment journey before the onset of turbulence in equity markets? And this is exactly what I'm going to explain in the remaining part of this video. At metacaps.ai, we use a whole bunch of global macro parameters in order to predict the onset of turbulence in equity markets. In this video, I'm going to focus on one such global macro parameter in order to illustrate to you how these global macro parameters can be used to predict the onset of turbulence in equity markets and accordingly slow down our investment journey. And in the process, achieve the sort of investment outcome that is orders of magnitude superior to what can be achieved through a traditional SIP-based investment approach. The global macro parameter that I'm going to focus on in this video in order to illustrate how to introduce an element of slowing down one's investment journey in the face of turbulence in equity markets is something called high yield spread or junk bond spread. Now, if you're not familiar with what is junk bond spread, then this is something on which I've done a dedicated video. I'd published this video on 12th of April 2025. If you haven't seen this video, I'll strongly urge you to go and have a look at this video. I'm going to leave a link to this video in the description of this video. But to quickly summarize what I had explained about junk bond spread, well, this is how junk bond spread in the US has trended all the way since 2007. One very important feature about US junk bond spread that you must be aware of is that historically, US junk bond spread has been a very reliable leading indicator of upcoming recessions in the US. In fact, as you can see in this chart, historically, whenever US junk bond spread has gone above the level of 10%, we have always got a recession in the US in the period after that. Another interesting feature about US junk bond spread is that historically, US junk bond spread has had a very tight inverse relationship with the Nifty here in India. The blue line that you see on your screen right now represents the Nifty. And as you can see, historically, the red line and the blue line have pretty much been mirror images of each other. Historically, whenever the red line goes up, the blue line, which is the Nifty, usually trends downwards and vice versa. Ladies and gentlemen, that said, many of you have commented that even though the red line and the blue line optically might look like they are moving in tandem but in opposite direction, one cannot really initiate any pointed intervention in one's investment portfolio based on changes in US junk bond spreads. But ladies and gentlemen, that's not true. And in this video, I'm going to demonstrate to you how you can initiate very specific interventions in your investment portfolio based on changes in US junk bond spreads, such that these interventions can lead to investment outcomes that are significantly better than what can be achieved otherwise through a conventional SIP-based investment approach. So this is what you got to do. This is a chart which depicts the historical relationship between US junk bond spreads and the Nifty here in India. We saw this chart a little while back. In this chart, we need to identify periods whenever there is a big spike in the red line, whenever there is a big spike in US junk bond spreads. Because as you can see in this chart, those are also the times when the Nifty witnesses big drawdowns. For that, let's get rid of the blue line and focus on only the red line. Now let's zoom into this chart and focus on just the last 1 year. Now to check if there's been a big spike in the red line, this is what you got to do. On the first trading day of every month, you got to check what is the prevailing US junk bond spread. By the way, when I refer to the prevailing US junk bond spread, I'm not really talking about the prevailing junk bond spread on that specific date. Instead, when I talk about the prevailing junk bond spread as of the first trading day of a month, what I'm actually referring to is the average of US junk bond spreads over the previous 30 trading days. So on the first trading day of every month, you first go and find out what's been the average of the US junk bond spreads over the previous 30 trading days. Then you go back 1 month to the first trading day of the previous month. And for this date, you once again repeat the same exercise. For this date, you try to find out what's been the average of the US junk bond spreads over the previous 30 trading days. So now you have the average of the US junk bond spreads over last 30 days as of the first trading day of the current month, and you have the same figure as of the first trading day of last month. Now based on these two figures, you need to calculate by how much has US junk bond spreads gone up or down between first trading day of last month and first trading day of the current month. And once you have these figures with you, you will be able to determine whether the red line is witnessing a big spike or not. Now the conditions that I believe are necessary for us to conclude that the red line is witnessing a big spike are twofold. Number one, the prevailing junk bond spread as of the first trading day of the current month must be equal to or greater than 3.75%. Second condition, US junk bond spreads must have gone up over the last 1 month by 5% or more than 5%. If both these conditions are met as of the first trading day of the current month, then that according to me is sufficient to conclude that the red line is witnessing a very big spike currently. And if the red line, which represents US junk bond spreads, if the red line is going up at a very fast pace, we have seen in my last video, that usually represents that liquidity conditions are tightening very, very rapidly. And liquidity conditions getting tighter can never be a good thing for stocks. Therefore, if both these two conditions are met as of the first trading day of the current month, then my suggestion is that you should move out of stocks for the coming month. You should move to zero equity in your SIP portfolio for the coming month, which effectively means that you should move your entire SIP portfolio to a liquid fund for the coming month. However, if these two conditions have not been met as of the first trading day of the current month, then that according to me means that liquidity conditions currently are quite stable, and in that case, you should continue to remain fully invested in your equity portfolio. So I'll summarize the plan of action once again. On the first trading day of every month, you should check for these two conditions. If these conditions have not been met, which basically means that even if one of these two conditions have not been met, in that case, you should continue with your SIP as is, which means that you should continue to have your entire SIP portfolio in Nifty, and the incremental SIP investment of that month should also go into Nifty. However, if it turns out that both these two conditions have been met as of the first trading day of the current month, then in that month, you should move your entire SIP portfolio to a liquid fund, and the incremental SIP investment of that month should also go into the same liquid fund. So based on these two conditions, on the first trading day of every month, you need to decide whether your investment corpus should be in Nifty or should be in a liquid fund for the coming month. And you need to do this exercise for 5 years. Let's understand this with an example, and for that we need to go back to this chart. As of first trading day of April 2025, that is 1st of April 2025, the 30-day average of US junk bond spread was 2.99%. 1 month prior to that is on the first trading day of March of 2025, the 30-day average of US junk bond spread was 2.68%. So between the first trading day of March 2025 and the first trading day of April 2025, US junk bond spread went up from 2.68% to 2.99%. That's a month-on-month growth of 11.5%. Now, if you look at this through the lens of these two conditions, then what you find is that as of first trading day of April 2025, the first condition has actually not been met. The first condition is that the prevailing junk bond spread should be 3.75% or more. But we just saw that as of 1st April 2025, prevailing junk bond spread was only 2.99%. So this first condition was not met. How about the second condition? The second condition is that month-on-month growth of US junk bond spread should be at least 5%. In this case, we just saw that month-on-month growth was 11.5%. So this second condition has actually been met. Out of these two conditions, one of them has been met, one has not been met. But as per this rule, unless both the conditions have been met as of the first trading day of a given month, for that coming month, we should continue to remain fully invested in Nifty. And even the incremental SIP investment of that month should also go into Nifty. Only if both these two conditions have been met as of the first trading day of a given month, only in that case, as per this rule, we should move the entire investment corpus to a liquid fund for that coming month. In this case, as of 1st of April, since these two conditions have not been fully met, we should continue to remain fully invested in Nifty for the entire month of April 2025. And even the incremental SIP investment for the month of April 2025 should go into Nifty. So like this, on the first trading day of every month, we should decide based on these two conditions whether we should continue to remain invested in Nifty for that coming month or we should move the entire investment corpus to a liquid fund for that coming month. And we should continue to do this exercise for a period of 5 years. Now let's check out what's been the kind of investment outcome that has been historically achieved by rebalancing one's investment portfolio during the course of a 5-year SIP between Nifty and a liquid fund on the first trading day for a period of 5 years based on these two conditions. So this has been the historical performance of a conventional 5-year SIP in the Nifty. We saw this chart a little while back. Best case return of 20.35% per annum, worst case return of negative 5.82% per annum. And this has been the historical performance of a 5-year SIP, wherein the SIP portfolio has been rebalanced between Nifty and a liquid fund on the first trading day of every month based on changes in US junk bond spreads, basically based on the two conditions that we just discussed. By the way, the liquid fund that I've used for the historical backtesting of the strategy was HDFC Liquid Fund. Best case return, 25.93% per annum. But look at the worst case return, positive 8.26% per annum. Just by ensuring that you exit equity markets during times whenever there is a spike in US junk bond spreads, the outcome of a 5-year SIP improves from negative 5.82% per annum to positive 8.26% per annum. That's a swing of more than 14 percentage points. Not just that, look at the median case returns. Even the median case return improves from 12.45% to 14.68% per annum. That's an improvement of more than 2 percentage points. By the way, if you don't know what is median, how is it different from average, and when it comes to investment outcomes, why is it better to look at median rather than average, then this is something that I have already covered in this earlier video of mine, which I had published on 27th of August 2024. You don't have to go through the entire video, just go and have a look at this 3-minute section from this video starting from 25 minutes 31 seconds. I'm going to leave a link to this video in the description of this video. Now, if you're going to rebalance your SIP portfolio between an index fund tracking the Nifty and a liquid fund, then you're going to face two key challenges. First is exit load. Most mutual funds in India apply an exit load of about 1% of the portfolio value if you redeem or switch out of your investment in less than 1 year. The second challenge that you're likely to face, and this is going to be the bigger challenge, is on the taxation front. If you're going to rebalance your portfolio every month, then most of the gains that are going to accrue to you are likely to be short-term gains. And as you know, taxes on short-term gains are significantly higher than that on long-term gains. And that's why the taxation impact is likely to be very, very high if you are going to execute this investment strategy using mutual funds or ETFs. So what is the solution? Well, as I mentioned in many of my previous videos, We prefer to execute these strategies involving monthly rebalancing of the investment portfolios using something called ULIPs, which stands for Unit Linked Insurance Plan. And that is because in case of ULIPs, there are no exit loads when you switch between funds. Second, and the most important advantage of ULIPs, in case of ULIPs, whenever you switch between funds, there is no incidence of any kind of capital gains tax. At this stage, I also must add that in case of ULIPs, there is usually a lock-in of 5 years, which means that you cannot stop your SIPs or redeem your investments in the first 5 years. But in lieu of this 5-year lock-in, you get these two very important advantages in case of ULIPs, which is while switching between funds, there are no exit loads. And while switching between funds, there is no incidence of any kind of capital gains tax. But you have to be very, very careful while investing in ULIPs because they carry very, very bad reputation on account of egregiously high charges that they have historically imposed on investors who have invested in ULIPs, because of which most investors who have invested in ULIPs in the past have not ended up with very good returns. And the primary reason for that is something called allocation charges. Allocation charge is basically a form of entry load that ULIP companies deduct from your investment. And quantum of allocation charges can range from 6% to 10% of your investment amount, which basically means that for every 100 rupees that you invest in a ULIP, the ULIP company is going to deduct anywhere between 6 rupees to 10 rupees in the form of an entry load right at the beginning of the investment. And what gets actually invested is only in the range of 90 to 94 rupees. And ladies and gentlemen, whenever charges are going to be so high, final returns can never be good, no matter how well the investment performs. So what's the solution? Well, the solution lies in this new breed of super low-cost ULIPs called zero allocation charge ULIPs. As the name suggests, there are no allocation charges in case of zero allocation charge ULIPs. Whatever you invest, the entire amount gets invested. There is no deduction on account of allocation charges. The only problem with these zero allocation charge ULIPs is that it's going to be very difficult for you to find an agent or intermediary who will be prepared to sell you these zero allocation charge ULIPs. And that is because the brokerage paid on these zero allocation charge ULIPs to agents and intermediaries is so low compared to brokerage paid on other traditional ULIPs that most agents and intermediaries are usually not interested in selling these zero allocation charge ULIPs. But ladies and gentlemen, it goes without saying that if you're investing in ULIPs, then you have to ensure that you're investing in only zero allocation charge ULIPs. Now, some of the zero allocation charge ULIPs that I've used for my own personal investments as well as those of my clients are HDFC Life Click to Invest and Bajaj Allianz Goal Assure. And no, this is not a paid endorsement. I have not received any consideration from these two companies to talk positively about their zero allocation charge ULIPs. The only reason I'm sort of endorsing them is because I use them for my own personal investments as well as investments of my clients. Now let's look at what's been the historical performance of SIP when you do monthly rebalancing of your SIP portfolio based on changes in junk bond spread using ULIPs. Let's start once again with the historical performance of a conventional 5-year SIP in the Nifty. We saw this chart a little while back. And this is the historical performance of a 5-year SIP when you do monthly rebalancing between Nifty and a liquid fund based on changes in US junk bond spread. Now let's look at the historical performance of this strategy when you apply this logic to a Bajaj Allianz ULIP. The fund that I'm using here on the equity side is called Bajaj Allianz Equity Growth Fund 2. It's a large cap fund offered by Bajaj Allianz. And the fund that I'm using here on the debt side is called Bajaj Allianz Bond Fund. And this has been the historical performance of a 5-year SIP when you do monthly rebalancing between these two funds based on changes in US junk bond spreads. Basically based on the two conditions that we discussed earlier in this video. Best case return, 25.34% per annum. Worst case return, positive 8.47% per annum. Median case return, 17.62% per annum. So worst case outcome improves from negative 5.82% per annum to positive 8.47% per annum. That's an improvement of more than 14 percentage points. Median case outcome improves from 12.45% per annum to 17.62% per annum. That's an improvement of more than 5 percentage points. And finally, let's look at the historical performance of the strategy when the logic is applied to a mid-cap fund of Bajaj Allianz. Here, the fund that I'm using on the equity side is called Bajaj Allianz Mid-Cap Accelerator Fund 2, which is a mid-cap fund offered by Bajaj Allianz. And the debt fund that I'm using is Bajaj Allianz Bond Fund. And what's the historical performance of the strategy been like? Best case return, 32.9% per annum. Worst case return, positive 9.96% per annum. Ladies and gentlemen, I want you to take a pause and understand the gravity of this. Even the worst case historical outcome is nearly in double digits. Compared to the worst case outcome of a conventional 5-year SIP in the Nifty, what you have here is an improvement of almost 16 percentage points. Not just that, look at the median case outcomes. In this case, you get a median case outcome of 21.66% per annum. That's more than 9 percentage points higher than the median case outcome of a conventional 5-year SIP in the Nifty. Ladies and gentlemen, this is the kind of improvement in outcome that you get when you introduce an element of market timing in your SIP, when you introduce an element of slowing down your investment journey in the face of turbulence in equity market based on changes in one global macro parameter. In this case, that is junk bond spreads. And the best part is that you can execute this strategy all by yourself without having to buy anything from me or any other advisor for that matter. I have given you the complete logic. I have given you the ULIP plan and the funds within the ULIP plan that you can use to execute this strategy. Apart from this, the only thing that you would need in order to execute this strategy would be to source the data related to junk bond spreads. Daily data related to junk bond spreads is available publicly. I'm going to leave a link to the data source in the description of this video. Ladies and gentlemen, I'm drawing towards the end of this video, but before ending this video, I want to touch upon something that is really close to my heart. I often get accused of subtly trying to push out proprietary strategies onto my viewers. But my dear friends, that's not true. Far from it, I often go to great lengths, including in this very video, to reveal substantial parts of our proprietary strategy to my viewers. For example, the details about our proprietary strategy that I have revealed in this video itself is the outcome of years of research. And yet I routinely share proprietary bits about our investment strategy in my videos so that anyone who is willing to invest time and energy to learn about these strategies can do so and then can implement these strategies without having to buy anything from me. And I do so because I'm acutely aware of the fact that a large section of my viewers who would otherwise want to invest with me are not able to do so because of the minimum ticket size we insist on, which is admittedly on the higher side. Now coming to those who do not have the bandwidth to learn about our investment strategies and then execute these investment strategies on their own, and hence they need our help to manage their investment portfolios. For them, as I announced in my last video, we have reopened the window for onboarding new clients for our flagship AlphaSIP strategy. In this video, I gave you a strategy to rebalance your portfolio every month between an equity fund and a debt fund based on changes in one global macro parameter, which is US junk bond spread. In case of our proprietary AlphaSIP strategy, we rebalance our client portfolios every month based on changes in more than 15 global macro parameters. And therefore, the performance of the AlphaSIP strategy, as you can imagine, historically has been significantly better than the historical performance of the single variable strategy that we discuss in this video. We offer our flagship AlphaSIP strategy in 3 variants. I've covered these 3 variants in my last video, which I had published on 18th of May 2025. You can watch this video from 27 minutes 3 seconds to 29 minutes 8 seconds to know about the 3 variants in which we offer the AlphaSIP strategy. And then you can go to our website metacaps.ai/products. On this website as well, you can find all the details about the 3 variants of the AlphaSIP strategy and that of all the other investment strategies that we offer to our paying clients. And if you're interested in any of the strategies listed on our website, then you can register through our website for the strategy that you're interested in, and somebody from our investment team will get in touch with you to take the discussion forward. Ladies and gentlemen, that's it for now. This brings me to the end of this video. I sincerely hope that you liked the insights that I shared during the course of this video. If you did, then please do like and share this video, and please do consider subscribing to my channel. Thank you very much for watching this video. Goodbye till we meet again in the next video.